Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. If you like making money, if you want to know about what the most undervalued assets are in the world, what the best investment opportunities that lay in front of us, click subscribe. Today I want to cover inflation and what the best hedges are against inflation. So how do we hedge inflation? I'm going to go through a couple of things that I'll give you a Goldman Sachs quote. I'll give you some areas or sectors that do very well to hedge against inflation. And then I'm going to test that hedge of inflation against the returns of those commodities the last bull market. So let's get in here and take a look to see how well our commodities hedge inflation. So first I'm going to start with a quote, Goldman Sachs. This is what they say about the next upcoming commodity boom. We see supply across all of these markets chasing demand higher, but not catching up, leading to demand pull inflationary pressures, even in oil. Moreover, commodities are the crucial link between growing demand, a weaker dollar, and inflation, which is why they have been statistically the best hedge against inflation, they said. Here is the asset on the left. This is the regression beta, which means how well they hedge against inflation. And this is the adjusted R-squared value, which is basically how well the data fits together. The higher the R-squared value, the better. So they're saying that the global, maybe that's Goldman Sachs commodity index, petroleum subindex. The best is petroleum for a hedge, and the energy is next. This could be maybe like a uranium or natural gas or something like that. GSCI, which is the commodity index, carbon neutral commodity index, the S&P 500 energy. BCOM, I'm not sure what that is. Business, I don't know what that is. Industrial metals, subindex, agricultural, and precious metals. So the ones that I really like to look at and that I'm heavily invested in myself are the ones that are stuck up here. I'm looking at uranium, I'm looking at natural gas, I'm looking at oil, and I've done other videos on the returns of past bull markets. So I want to show you what some of these have returned during the last bull market to basically show you what this means. They're saying that energy, petroleum, and other commodities are the best hedges against inflation. So let's test it. So I'm looking at the 2000s bull market. I went back and I crunched some numbers and I threw them up here. During that last bull market, gold went up 7.5 times, silver went up 12x, platinum 7x, palladium 0.2x. Palladium didn't do very well. Copper went up 7x, nickel went up 11 to 12x, tin was 8 to 9x, and zinc was 6x. So those were the metals. In energy, oil went up 12 to 13 times, uranium went up 23 times, and natural gas went up 8 to 9x. That is pretty good when compared to some of these metals. Now, nickel did very well, so did tin, and silver did incredibly well. I think oil and uranium just crushed it, that last bull market. So looking at some of the company returns just to show you, the company returns of EXK were 1,267 times. Paladin Energy, 1,200 times. EXK is a silver producer. AUI, Yamana Gold, 400 times. Chesapeake Energy, 90 times. SM Energy, 16 times. Norilsk Nickel, 29 times. And Vale, 20 times. That was from bottom to top of the last commodity bull market. These guys crushed it. Now, there's something I want to talk about that's different now and the last commodity bull market. So the differences between now and the last one is everyone in the world, as it seems like it, is aiming at copper for renewables and EVs. Nickel is another one of interest for the same reason. Uranium is a base load clean energy power source that is carbon free. These are going to shape up to be some of the best investments here, guys. Copper ore grades have declined and will put more demand for oil when they go to mine them and open up new copper mines. We are starting from the most depressed ever ratios on top of supply problems from COVID. This all spells incredibly good opportunities for investments in commodities because of inflation, because of the demand for these commodities, because of the demand for electricity, uranium that is, and it being a carbon-free generation of power, and even oil because we have to mine everything out of the ground with declining ore grades. So my opinions are uranium, oil and gas, silver, copper, tin, nickel, platinum, gold. They are all incredible opportunities, all of those. They are all good. I am diversified amongst all of those with individual companies, with ETFs, with mutual funds, with everything. I'm covering it left, right. I've got physical metals of some of them. I'm covering my butt everywhere. So the valuation lows, I want to talk about this because this time is different because COVID's starting off this commodity boom and screwed up the supply side. It also screwed up the ratios. It went so far down. So oil reached a record of 1 ounce gold to 90 barrels of oil, and the highs are typically around 1 to 8. That is a high for oil. That ratio compresses 11 to 12x. The last bull market was a 5x compression. This one, 12 to 13x is my guess. So that is an incredible difference for the price compressing against gold. The opportunities are over 2 times last bull market. That's what I'm seeing. It's twice as good. Now uranium's at a 1 gold to 62 pound ratio. Let's say the top hits around 1 to 4. That's a 15 to 16x compression. The last bull market, when everyone was saying uranium was just absolutely ridiculous, was an 8 to 9 times compression. So what I'm expecting this times around is we could see a 23 times compression. We could see that. And that's price. That's a 23x is the price. Sorry. That's the total price move. Above is 12 to 13x price move. But we're seeing a 15 to 16x compression against the ratio. So a 23x times of price, you guys can do the math. 23 times, maybe it's $28 or $30. It's $700 or so. So silver. Silver, again, at an anomaly, a 1 to 100 ratio. I think it's possible to hit a 1 to 10 ratio. Why is that? Because we are going to use silver like mad in all of these renewables. And in all of these things that we want to do in the world, we're going to use more and more silver. The compression there is a 10x. Last bull market was a 3x compression. Its potential, 12 times price move. So this bull market has greater potential than any bull market in the history because of the very low depressed starting points that COVID created. So the conclusion here is I think an allocation to all these areas, in my opinion, is a good thing. Diversify amongst them. I don't know exactly which one will be the best, but we have so much potential here that I would be inclined to get whatever sectors, whatever they bear in terms of performance, I want to capture. Valuations at the beginning of this bull market with COVID made extreme valuations to the downside in some of these commodities. The projected market balances, or the way that we like to talk about it, is deficits of some of these metals should hold some weight for portfolio allocation. And what I mean by that is copper, silver, uranium. There's big deficits out in the future. Huge opportunities for investment. Energy is the foundation of all work that's performed in this world. I like to take that into account. If things are getting harder and harder to extract out of the earth, and energy is the foundation of all work being performed, we need to take that into account. I think the investments in energy, if they're the best inflation hedge, is probably a good spot to be. And if they are also experiencing large market deficits and have carbon-free emissions, uranium is what I'm pointing to, I think that's an excellent opportunity for investment. So if you guys like this content, give me a thumb up. Let me know what you guys think in the comment section. Love to hear your guys' opinion. And thank you for listening. This is Finding Value.